Good afternoon, and thank you everyone for attending today's webinar, Impact of Tax Cuts and Jobs Act on Physicians and Group Practices, presented by Spiro Liunas. Please be aware that there will be a question-answer portion today at the end of the webinar. To avoid frequent interruptions during the webinar, please type your questions in the question box located on the right of your screen. They will be answered in the order received during the question-answer portion. Additionally, an electronic version of this presentation will be emailed to all participants following completion of today's webinar, and a recorded version will be available on the website for members only. Again, NJMGMA would like to thank you for attending, and I'll now turn things over to Spiro.
Good morning, everybody, or good afternoon. My name is Spiro Liunas. I'm a partner here at Withum Smith & Brown. I'm the leader of the firm's large physician practice group. Today, we're going to go ahead and review the Tax Cuts and Jobs Act and its impact on physicians and physician groups. Okay. Before we get started, I want to tell you a little bit about Withum. Withum was established in 1974. It's the 26th largest CPA firm in the U.S. It's the 6th largest in the Northeast, with 16 offices across the U.S. It was named one of the best accounting firms to work for by Accounting Today, and the firm has 15 different industries with services including advisory services, assurance and accounting, forensic and valuation services, private client services, and tax services. The firm has 15 different niches, with healthcare being one of the largest, serving hospitals, physicians, nursing homes, and FQHCs. The firm is also a member of HLB International, which is an affiliation of accounting firms throughout the world, so this way we could better serve our clients. So the effective date for this tax law that was signed on is as of December 22nd, 2017. Unless otherwise noted, the changes are effective on January 1st, 2018. We can expect additional complications at the state and local level because many states automatically adopt federal changes. Others may adopt them in part or in whole at some future date. Because many states do follow the federal tax law, some of the impact may be negative at the state level. So many states are making changes to go ahead and counteract some of the changes at the federal level. What we'll review in the next few slides will be the individual changes and the tax rates at each of the individual levels, from single to married filing joint, and so on and so forth. The most drastic change that you will notice is that there's been a reduction in the tax brackets, with taxable income kicking in at lower levels. At the 10% level, the tax rate is the same as it was underneath prior law. However, what you'll notice, as taxable incomes increase, even though the tax rates do go up, we do have significant changes. We went from 15% down to 12% at the next level. From 25%, we dropped down to 23%, and so on and so forth. The most significant change that you will notice, okay, will be at the 35% level. At the 35% level, what you'll notice is that underneath the current law, we have 35% kicking in at taxable income between $200,000 and $500,000. Under prior law, it kicked in at $416,701 to $418,000. So what you'll notice is that you have a much broader range of income being taxed at a lower level, and the 37% rate kicks in at anything above $500,000. Under prior law, the highest tax bracket at 39.6% kicked in at $418,000. For married couples filing joint, again, same rates. However, if you do look at the 35% bracket, again, what you'll see is that you've got 35% rate kicking in at taxable income between $400,000 and $600,000 versus $416,000 to $470,000 underneath prior tax law. So you have $200,000 of income being taxed at 35% in 2018 in that 400 to 600 range versus 416 to 470 underneath the prior law, which is only $54,000 between the two. And again, you've got the 37% tax bracket kicking in at 601 underneath prior law. It was kicking in at 39.6%, but at an income level of 470, so much, much lower underneath the prior law. So for married couples filing separate, essentially you have the same brackets, but the income levels, the tax brackets kicking in at half the rates that they were underneath married couples filing jointly. And under head of household, again, same theme. 10% rate at the first 13.6 or 13.3 underneath prior law, 12% versus 15%, 22 versus 25. And again, at the 35% level, you've got a range of $300,000 of taxable income and $200,000 to $500,000 versus $416,000 to $444,000. And then again, 37% on anything above $500,000 versus 39.6%. So as we're going through these slides, what you're noticing is that you do have lower tax rates, but you also have levels of income being taxed at lower rates. So again, much more beneficial to many taxpayers that are out there. Some additional changes that we have. There was some simplification with this tax code. Believe it or not, we did go ahead and accomplish that. The way that was accomplished is by simplifying some of our deductions. The standard deductions have now increased in comparison to prior law. For a couple filing jointly, the standard deduction is now $24,000, $18,000 for a head of household, or $12,000 for single filers. Some additional changes that came about with the new tax law. There was some talk about getting rid of the individual alternative minimum tax. However, they kept the alternative minimum tax in place for individuals, but there were some significant changes. The AMT remains, but the exemption amount that you receive is higher. It's $109,400 for married filing taxpayers versus $70,300 for single taxpayers. Now, this exemption amount starts to phase out, and that phase out is much higher than under prior law. The phase out kicks in once your income hits $1 million if you're married versus $500,000 if you're single. So what I mean by that is, in our first bullet point where we have an exemption of $109,400, once your income hits $1 million, that $109,400 is reduced, okay? Under prior law, that phase-out exemption was at a much lower income rate. Also, other things to consider. There are certain items which put you into the alternative minimum tax under prior law, such as personal exemptions, state and local income taxes, and other miscellaneous itemized deductions, such as tax preparation fees and unreimbursed business expenses. Those deductions are gone. With those deductions being gone, it is more likely that fewer taxpayers will fall into the alternative minimum tax. The deductions for personal exemptions are suspended. However, there has been an increase in the child tax credit for tax years beginning after December 31st, 2017 and before January 1st, 2026. The tax child credit is increased to $2,000, okay? That's a very significant change. Also, the capital gains rate has not changed. That is the same as it is underneath prior law, as you see in our two bar graphs there. The Act does have a significant change to the state and local income tax and property tax deduction. That deduction is now limited to $10,000 for taxpayers married filing joint. For taxpayers married filing separate, that deduction is now only $5,000. This is for tax years beginning after December 31st, 2017, before January 1st, 2026. At year end, at the end of 2017, some taxpayers were scrambling. With these tax deductions going away, many taxpayers were wondering whether or not they could go ahead and prepay certain state taxes before year end to avail themselves of a deduction in 2017 rather than 2018. The law that was put forth at that time was that any prepayment of state income taxes would not be allowed as a deduction. So if you wanted to go ahead and prepay all of your 2018 state income taxes, you were not allowed a deduction. What was allowed as a deduction were any real estate taxes that were paid. So if your 2018 real estate taxes were assessed, if you prepaid those real estate taxes before December 31st, 2017, you were able to go ahead and obtain that tax deduction. Another significant change in the Act, it reduces the mortgage interest deduction to interest on home to interest of indebtedness of $750,000, but this is for debt incurred after December 1st, 2017. The $1 million limitation remains for older tax debt. So if you did have debt, if you did have a home mortgage that was in excess of $750,000 before December 1st, 2017, but limited to the $1 million as we had under prior law, you were okay. You're okay. So you don't have to worry about losing any of that interest deduction up to $1 million of mortgage debt. For tax years beginning after December 31st, 2025, the limitation reverts back to the prior law, which is $1 million, regardless of when the debt was incurred. The Act also suspends the mortgage interest deduction for interest in home equity indebtedness for tax years beginning after December 31st, 2017, and before January 1st, 2026. Some additional changes in the tax law. The Act suspends the overall limitation on itemized deductions, again, for tax years beginning after December 31st, 2017 and before January 1st, 2026. What that means is, under prior law, once your income hit certain levels, your itemized deductions were limited, okay? Underneath the current law, that limitation is now gone. Another significant change to the Act is that it limits your miscellaneous itemized deductions that were subject to 2% floor. So what does that mean? Any physicians that had any unreimbursed business expenses, such as continuing education, dues, licenses, travel for work, for any conventions or education, those underneath the prior law, those deductions were allowed. Underneath the current law, those deductions are now gone. The Act does increase the limitation for cash contributions from 50% to 60%. Under prior law, the amount that you can get a deduction for contributions to charity was limited to 50% of your adjusted gross income. That limitation is now at 60%. Again, this is for any contributions for tax years beginning after 2017 and for 2026. Also, for tax years beginning after December 31st, 2026 and before January 1st, 2019, the Act reduces the deduction for the limitation for medical expenses to 7.5% of your adjusted gross income. That was at 10%, so that is a benefit for you. Now, just to kind of break away for a second, the tax law that was put in place was primarily to go ahead and fund the tax cut at the corporate rate. So there have been some limitations in certain deductions that were allowed. One of those being any excess losses. For any tax years after 2025, we have a new definition for excess business losses. Any excess business losses will no longer be deductible in the current year. Instead, those losses would be carried forward. So what's an excess business loss? An excess business loss is the excess of the taxpayer's total trade or business deductions and losses over their total income and $250,000 if you're single, or $500,000 if you're married filing joint. So in this example, if you have an overall loss, okay, from your business activities, and that loss exceeds $250,000 if you're single or $500,000 if you're married, you can't take that deduction in the current year. That deduction must be carried forward. We'll touch on this in a little bit, but there was a significant reduction in the corporate income tax. So in order for everyone deciding to switch what type of entity they were taxed as, and what I mean by that is S corporation versus a C corporation, or partnership versus a C corporation, there's a new deduction that was added to the law, and that's the qualified business income deduction. So the new tax law provides for a deduction equal to 20% of qualified business income, but that is capped, and it's capped to the greater of 50% of the individual's allocable share of W-2 income deducted by the business, or 25% of the individual's allocable share of W-2 wages deducted by the business, plus the individual's share of 2.5% of the unadjusted basis of the property used in the business. Not exactly tax simplification. But what this deduction does do, it reduces your effective tax rate from 37% down to 29.6%. There are limitations and exceptions. The wage limit that I mentioned above doesn't apply. The taxpayer earns less than $157,500 if they're single and $315,000 if they're married. The deduction is not available to owners of certain businesses, certain service businesses, unless the income is less than $157,500 or $315,000 if you're married. So this deduction isn't available to certain professions, which I'll go ahead and touch upon. The deduction is available to shareholders in an S corporation, partners in a partnership, sole proprietors reporting directly on Schedule C, or owners of rental property reported directly on Schedule E. So what's qualified business income exactly? It's the ordinary business income from a sole proprietorship, rental property, S corporation, or partnership. It does not include certain types of income, such as interest income, dividend income, capital gain income, or income that is not effectively connected with the U.S. trade or business. So what's a qualified business? Any trade or business other than a specified service business or the business of being an employee. So if you're an employee for multiple companies, this deduction is not available to you. So what's a specified service business? So we have to go ahead and look to Section 1202E3A, which states that any trade or business involved in the performance of services, including the field of health, law, engineering, architecture, accounting, actuarial sciences, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. That's the killer and catch-all if you wind up falling out of one of these other types of businesses. The code specifically removes architects and engineers from the list of disqualified businesses. The reason why they took out architects and engineers was because the Congress wanted to go ahead and encourage manufacturing and building, and because those professions are integral in those types of businesses, they wanted to go ahead and carve those specific professions out. So what exactly constitutes providing services in the field of health? We have a regulation section. So the performance of services in the field of health means the provision of medical services provided by physicians, nurses, dentists, and other similar healthcare professionals. The performance of services in the field of health does not include the provision of services not directly related to a medical field, even though the services may be somewhat related to the health of the service of the recipient. So for example, a gym, okay, or a health spa, even though may be beneficial to someone health-wise, it would not be, this deduction would not constitute the providing of health or healthcare type services. There was a private letter ruling where a taxpayer wanted some clarification as to whether or not they would meet the definition of providing services in the field of health. So in this case, there was a developer of a tool used to provide information to healthcare providers. They were not providing services in the field of health underneath 1202. So where it didn't provide healthcare professionals with diagnosis, treatment recommendations for treating patients, and the taxpayer wasn't aware of the healthcare provider's diagnosis or treatment of patients, and the only contact was with patients was regarding billing, and the only medical professional was the director. None of the company's employees were considered to be providing services in the field of health. Now, this is important because many clients are asking, many physician clients are asking, what can we do to go ahead and qualify for this qualified business income deduction? There isn't a lot of clarity out there. So the question is, can a physician practice go ahead and set up an MSO to obtain the qualified business income deduction? Well, the issue is, what activities can we go ahead and carve out from the medical practice and assign to a new entity, so this way we can take advantage of the deduction? The other question is, how do you define wages in a partnership or a sole proprietorship? If you go back to our definition to qualify for the deduction, it was based on wages. But in a sole proprietorship or a partnership, we don't have wages. The owners take their distributive share of the profits. The other issue is that the IRS may attack the transaction of setting up an MSO just to take advantage of the deduction. Okay, so unfortunately, there's not a lot of guidance out there for us to go ahead and determine what sort of activities we can go ahead and carve out to put into a separate entity to take advantage of the deduction. So now your question is, if we can't go ahead and set up an entity or an MSO, how can we go ahead as physicians take advantage of the deduction? One way of doing that is to get physicians' income below the threshold levels to qualify for the deduction. So here we have two examples. We have two physicians with income of $440,000. What the physician can do is implement a retirement plan. So in our first case, we don't have a contribution to the retirement plan. In the second case, we have a $125,000 contribution to the retirement plan. That reduces the taxable income to $315,000 versus still at $440,000 for the physician with no retirement plan. Underneath the $440,000 scenario, because that physician's income is above the threshold, they're not allowed to take the deduction. In the case where our income is below the income threshold, we get a 20% deduction of the $315,000 or $63,000. That reduces the physician's taxable income to $252,000 versus $440,000 underneath the other example. The contribution to the retirement plan reduced taxable income by $188,000. This results in federal tax savings of $57,742. So the $125,000 contribution to the qualified plan resulted in a tax shield of 46%. That's a very, very large deduction. I didn't include any state tax savings into the calculation because the tax savings will vary by state. Now, what the IRS didn't want, what Congress didn't want everyone to do was go out and try and get cute and fancy and take advantage of the deduction. So, of course, there's a penalty on anyone who takes the deduction who shouldn't have taken the deduction. So the penalty is 20% on any substantial underpayment of tax. Underneath the normal rules, okay, a substantial underpayment of tax is defined by any understatement of income tax for any taxable year if the amount of the understatement for the taxable year exceeds the greater of 10% of the tax on the return required to be shown, or $5,000. However, with regard to the QBI deduction, okay, that limitation is only 5% of the tax required to be shown on the return, or $5,000. So it's a much, much lower threshold. They don't want everyone running out to take advantage of this deduction. So the penalty kicks in at a much lower threshold. Now, underneath the new tax law, we do have a reduction in the corporate tax rates, which I will go ahead and cover in a few slides. If someone decides to choose to be an S corporation versus a C corporation, as many older physician practices are, that tax rate is now 21%. Any distributions, okay, from a C corporation are typically subject to a 23% tax to the individual, okay? However, underneath the new tax law for the first year, any distributions as a C corporation will not be taxed as a dividend, okay? An S corporation has a separate account called the accumulated adjustments account, and any earnings, any undistributed earnings that are sitting in that account won't be subject to the tax. In the second year, the tax is prorated, and then there's a Section 481 adjustment. There's certain adjustments that come into effect when you're going from an S corporation to a C corporation. Those adjustments typically may result in taxable income or a deduction, and those adjustments will be taken into account over a 6-year period rather than a 4-year period. In order for the shareholders to take advantage of these distribution rules, the same shareholders must own the former S corporation in the same percentages 2 years after the revocation. So as I stated, the new corporate tax rate will now be a flat 21%. Any personal service corporations, such as medical practices and dental practices, will now be subject to a flat 21%, which compares to a flat 35% that was in effect before. So a very, very large tax deduction. In certain cases, certain corporations don't have a calendar year; they're on a fiscal year basis. Their tax year may begin on July 1st and then June 30th the following year. The tax rate will have to be a straddled rate at the former higher rate of 35% versus 21%. So let your accountant go ahead and figure that out. It's not an easy calculation. What I wanted to do was I wanted to go ahead and include an entity comparison chart to show what the changes are underneath the new tax rate. So in one column we have the C corporation, the other column we have the S corporation. So at first glance, it would appear that the C corporation would be more tax advantageous. We have a flat rate of 21%. Underneath the new S corporation rules, okay, there is no corporate level tax for an S corporation. Any income or deductions pass through directly to the individual. 29.6% rate here that you see, what effectively shows is the top tax rate of 37%, but also taking advantage of the new 20% QBI deduction. That QBI deduction effectively lowers the top tax rate from 37% on the individual to 29.6%, okay? At the state level, we're pretty much the same, 9% corporate level, 8.9% individual tax rate, so not much of a difference there. Total being 30% at the C corporate level, but 38.57% at the S corporate level. So at first glance, it would appear that the S corporation would be much more tax advantageous, but there's something else we have to go ahead and take into account. Okay, what we do have to take into account are any distributions from the corporation. Any distributions from a C corporation are taxed at a 23.8% to the individual, 8.97% for New Jersey, for a total tax rate of 32.77%. Okay. However, distributions from an S corporation are not taxable to the individual. So you see, we have a 32.77% difference in comparison. Another thing to go ahead and look at would be in the case of a stock sale. In the case of a stock sale, any shareholders of a C corporation would be taxed at a rate of 23.8%. But an owner of an S corporation would only be taxed at a rate of 20%. Same rate at the state level. But the total rate is 32.77% for a C corporation versus 28.97% at an S corporation. So that's a 3.8% difference. So now many folks are asking, am I better off as a C corporation or am I better off as an S corporation? Very often it depends on the circumstances that are in place. If you're looking for tax deferral, where you're looking to go ahead and defer some tax, it may be best to be a C corporation, okay? Especially in cases where you may have just one owner, doctor of the practice who may want to go ahead and invest through the C corporation. That may be more advantageous, but again, this should be looked at on a case-by-case level. Some additional corporate tax changes that came into effect. The corporate alternative minimum tax is now repealed, okay? As opposed to the individual level where it's not repealed, it's still in effect. Also, the domestic production activities deduction has been repealed. The Act also limits your net operating loss deduction to 80% of your taxable income and provides that amounts carried to other years be adjusted to account for the limitation for losses arising in tax years beginning after December 31st, 2017. Underneath the prior tax law, it was 100% deductible. The Act, I'm going to skip over the next point, but the Act eliminates also the carryback of net operating losses. Under prior year, if you had a net operating loss, you were able to go ahead and carry that loss back 2 years and amend the prior year return. Underneath the current law, that loss must now be carried forward. And it's carried forward indefinitely until it's used up. Physician practices are very, very capital intensive. So underneath the new law, Section 179 allows a taxpayer to expense up to $1 million of equipment and furniture and fixtures put into place. There was an income limitation that was in place at the time. That was $500,000. That income limitation is now up to $2.5 million. The Act also expands what we call qualified real property. Certain real property was not allowed to be expensed underneath Section 179. Underneath the new tax law, that property is now, if it qualifies, can be expensed underneath Section 179, and that includes roofs, heating, ventilation, air conditioning systems, and so on and so forth. And this is all improvements made to non-residential real property. So a medical office building would be considered non-residential real property. Many physicians still own their real estate, so this is something that they can go ahead and take advantage of. We also have bonus depreciation. Typically, when you acquire an asset, you have to expense it over a period of time, depending on the type of property that it is, 5 years, 7 years, 15 years, whatever it may be. Taxpayers can now expense 100% of the cost of qualified property that was acquired after September 27, 2017. So if any of the physicians on the line or any of the practices that are online that have extended their return, make sure you go ahead and look at when you purchased that property. If it was after September 27, 2017, that's a deduction you can take for 2017. Okay, so just be mindful of that. There will also be a phase-out period of 4 years. So that phase-out period will be 80% of the cost of qualified property in 2023, 60%, 40%, and 20%, so on and so forth, as you see in the presentation. Now, the bonus depreciation will apply to any asset with a regular depreciation life of 20 years or less. Typically, equipment is 5 years, furniture and fixtures is 7 years. Certain real property is 15 years. As long as we're 20 years or less, you could expense 100%. So that would also include computer software. Computer software was typically written off over a 3-year period. You can now take it right away. Any qualified improvement property. So since it has a 15-year life, it's automatically covered. We touch on a few bullet points there with regard to different depreciation methods underneath the ADS. We're not going to cover that. And also very, very important, with regard to bonus depreciation. Underneath prior law, bonus depreciation was at 50%, and the property had to be new. That is no longer the case. Underneath the current, with the new tax law, the asset no longer has to be new. It can be used just as long as it is first used with taxpayer. It can qualify for the bonus depreciation. There's also a new limitation for interest expense deduction. This would qualify. This limitation is for very, very large medical practices. For years after 2017, the net interest expense is only allowed to the extent of 30% of the adjusted taxable income. It doesn't include investment and interest expense, but this will only apply to businesses and physician practices with average gross receipts of less than $25 million. If you're a super group with average gross receipts more than $25 million, this may catch you. For flow-through entities, limitation is first applied at the entity level. Any excess interest is carried forward indefinitely. Doesn't apply to any electing real property trades or businesses, so any real estate entities this would not apply to. How do you calculate the business interest limitation? It's adjusted taxable income before any income deduction, gain or loss is not properly allocable to a trade or business, any business interest expense or income, any net operating loss deduction, any depreciation, or also any QBI deduction. So in figuring out what your taxable income level is, you have to go ahead and adjust for these. Another significant item that's going to affect physician practices. For years after 2017, no deduction is allowed for any activity generally considered to be meals and entertainment. So any tickets to any ball games, that's considered entertainment. That deduction is no longer allowed, okay? Underneath prior law, that deduction was limited to 50%. The deduction for business meals is still limited to 50%. That stayed the same. However, another significant change that came about as a result of the tax law were any meals that were provided on the premises. Underneath prior law, any meals that were provided to employees working through the day or directly on the premises, that deduction was at 100%. That deduction is now limited to 50%. So many physician practices do go ahead and buy lunches for their staff. This way they could work through the day. That deduction is no longer 100%. It is now 50%. So below, because this law is very voluminous, I've included a quick summary of any changes. You can go ahead and review it. If you have any questions, you can email me after. My contact information is on the last slide. But go ahead, review it, and any questions that you may have, please email me or call me. There are certain other tax changes that also came into effect. And these changes were going to come into effect regardless of the new tax law. There are new partnership audit rules. So without getting too much into the detail here, essentially underneath the new partnership audit rules, any audits of any partners used to take place at the individual. Any audits of partnerships very often would take place at the individual level. Now those changes will take place at the partnership level. So if there are any adjustments, the partnership will have to go ahead and pay the tax for the individual partner. Now, underneath the new partnership audit rules, you have very many physician practices that are set up as partnerships. I know there are quite a few anesthesiology practices that are set up as partnerships. Okay, in order to not be subject to the new partnership audit rules, certain partnerships can go ahead and elect out. So partnerships with 100 partners or less can opt out at the entity level, and this is an annual election. It has to be made with the tax return every single year. okay? The partners must include individuals, C corporations, or S corporations. S corporation shareholders must be counted for purposes of the 100-partner test, and the partnership must notify each partner of the election out. So it's not an easy process. We'll skip to the next slide. Now, very, very important. Any existing partnership agreements must now be amended to go ahead and reflect this change, okay? Each partnership must now designate a partnership representative. Partnership representative must be a person. The term person includes an individual, trust, or estate. They must have a substantial U.S. presence. The partnership representative is not required to be a partner in the partnership. It could be the CFO. And if there is no partnership representative, the IRS will go ahead and appoint. I've also included a summary of any tax law changes as it relates to corporations and S-corps. There's some additional information with regard to depreciation and asset expensing. Again, it's just a quick summary of the tax changes that have been put into place. That's all I have right now. Are there any questions?
If there are any questions, you can type them in the question box on the right of your screen. And there aren't, so we'll just give it a minute to see if any come in. Again, if there are no questions, we'll close the webinar for today. Thank you, Spiro, for presenting, and the webinar will be available to members on the members only section of the website and also emailed out to all the participants. Thank you.
Thank you. Bye-bye.
Bye.